Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And some time ago, I started a series of 3 webcasts that I intended to cover the 3 reasons why traders trade options. Really, if we lump them under 3 big umbrellas, all those different strategies, we might be able to describe 3 primary driving purposes for traders that trade options. And we started with episode 1, which was a discussion of speculation with options. And I intended to move on to episode 2. I haven't had a chance to get to that yet, so today's the day. We're going to be going into the second reason why traders trade options, and that is for income. Now, in episode 3 next week, we'll talk about the final approach to trading options, which is hedging. So for today, income is the focus. I'm going to be going through 2 example strategies. We're going to be placing a trade today. Should be an interesting discussion. Before we can get to any of that, though, let me first of all say hello to everybody that's chatting in out there in YouTube. Great to see all the familiar names. I already see some people identifying themselves as a first-timer here, so great to see Sharon and Ricebird. Hello there, Life in the Fast Lane. Prakash, E. Dunny, Eric, Richard, Wacky, Joy Seekers, Charles, Jack, hopefully I said Eva, and Lawrence, and everybody else. Neil, thanks for joining us. We definitely appreciate those that are returning, joining us again. Always appreciate your attendance and your contributions to these discussions. If you are among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. I always say that's a great way to watch these webcasts, but if you'd like to be here in our live stream audience, this is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Love to have you here. Now, I also want to let everybody know who's here in the live stream audience that my very good friend Mike Fairborn is hanging out in the chats with you. He's going to be addressing any questions that I can't get to just during the flow of the presentation. Mike brings a ton of experience to this discussion. We've been working together for nearly 20 years. So thanks for having my back there, Mike. Mike and I would also like to issue an invitation to everybody to follow us on social media. You can find Mike and me on X. You can find and follow Mike there at Mike Fairborn CS. You can find me on X and give me a follow at Cameron May CS. And you can also find and follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. All right, but let's get into this discussion. Joy Seekers Project, first time, great to have you here. Hope you enjoy it. I think that you're going to see a lot of value in these webcasts. So yeah, always great to see the new attendees. But as we get into these, of course, we always need to first consider the risks associated with trading and investing. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research. Investing involves risks, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and any investment decision you make in your self-directed account is solely your responsibility. All right. So let's lay out an agenda for what we're going to be discussing. So as I mentioned some time ago, I'm going to give myself a little bit of grace here. My apologies. I had some other things get in the way. But I kicked off a series of 3 intended episodes covering the 3 primary reasons that options traders trade options. And the first one was speculation, where we might be, where a trader might see an opportunity in the market, at least by their definition, and the attempt is to leverage that opportunity using options. So we discussed the pros and the cons, used a couple of example strategies for that. I'll show you where to find episode 1 in just a moment. But that brings us to episode 2 of the 3 reasons. The second reason is for income. So today I want to talk through how income strategies work with options. I want to talk through 2 example strategies and make sure that we place at least 1 trade by the end of the discussion. That'll have us ready for episode 3 next week, which will cover using options to hedge other positions. So I think it's going to be a great series. But since I am playing a little bit of catch up here, let me show you where to find episode 1. If you're new to the channel, welcome again. Great to have you. But make sure that you've subscribed. So pop down below the video right now. You can click on the subscribe button. It only takes a second to do that. It doesn't cost anything to subscribe to our YouTube channel, but our Trader Talks Schwab Coaching Webcast channel on YouTube is where you can find previous webcasts, including episode 1 in this 3-part series. So here's how I'm going to show you how to find this. So you go to YouTube, find Trader Talks Schwab Coaching Webcast, click on the little search icon here, and we're going to look for 3 reasons. There we go. Type it a little bit better than I do. In any case, there we go. The 3 reasons traders trade options, episode 1, speculation. So you'll notice this was a few months ago. That's why I wanted to show you a little bit of shortcut to find this quickly. So that has this stage set for episode 2, which is income. So to set sort of a conceptual foundation for this discussion, let's pop over here to Thinkorswim. Now, again, if you're new to this webcast series, if you're new to Schwab coaching in general, very commonly you'll see us using trading software. It's known as Thinkorswim, where we can trade in a simulated trading environment. Now, this software can be downloaded free of charge from within your Schwab online account. Just log into schwab.com, go to Trade, the Trade tab, and you'll see that as one of the drop-down choices in the menu. Thinkorswim is, again, what you'll be looking for. You just download Thinkorswim there, log in using your Schwab username and password, and that'll have you in the software just like we're seeing today. All right, so now, Charles, you like this? It's a great recap and a teaching plan. Good. Yeah, because there are dozens and dozens and dozens of potential option strategies. And so when we first start trading options, it's a natural question to try to skip to the end. What is the purpose of trading options? You might think it's always just for profit. Well, sometimes it is. Other times it's to protect profits, and profits can be generated in a couple of ways. We can speculate on a move and hopefully generate a return, or the trader might be using options as a potential for income. So on that topic of income, let's have a look at Amazon. Now, Amazon, let's put ourselves in the shoes of an investor or a trader who purchased Amazon maybe in recent months, and it's gone pretty well. So I just circled a date back here. Let's say that we're an investor bought that around 210 bucks. All right. Now the stock has really taken off since then, and it's climbed back up to previous highs. But what you'll notice is that over the course of the last 12 months, and really in the history of Amazon, we've never had a day where the price has closed above $255. So there's apparently a little bit of a price ceiling. Doesn't mean that price ceiling is going to stay there forever, but let's just say that our owner of Amazon shares, pardon me, our owner of Amazon shares is looking out on the near-term horizon, and they think Amazon's going to kind of go through a little bit of a rough patch as it tries to push through this 255 price ceiling. And you might be able to even see a little bit of hesitation over the last couple of weeks where we've attempted to push up and then get pushed back. And right now, today, still trying to push above 255, but retreating back down to around 253. So here we are. We have Amazon in our portfolio, 100 shares, theoretically purchased back there around 210 bucks. Right now it's worth about 253. But our trader has a problem here. And that is, it doesn't look like Amazon's likely to produce returns in the form of capital appreciation anytime soon. And let's say they just think that Amazon's kind of going to bump its head, and maybe for the next couple of weeks, few weeks, it might pull back. Now, they might choose to just hit the panic button and sell the shares, or maybe they're just totally satisfied with the profits that they've made already. That's okay, whatever. But let's say instead of doing that, they turn to a different way to generate potential profits from a stock position, and that's by recruiting options in pursuit of income. So the first strategy that we're going to be discussing today is going to be called a covered call. Now, I know that not everybody knows what a covered call is, but it consists basically of stock ownership, which we already have, and then we're going to sell an option that's related to those 100 shares of stock that you just saw me show in the example portfolio. So here's going to be strategy number 1. Let's open up our scratch pad. So we have income. Let's make this nice and bold. It's a little bit thin, difficult to read. There we go. income, not income, income. If you could see the way I have my fingers arranged on my keyboard right now, you would be horrified. One thing I didn't ever learn to do is to type properly. Income strategy number one. There we go. Finally got it out. And that is a covered call. There we go. And it starts with share ownership. All right. Well, we own 100 shares and they're currently worth, let's just call it 253 bucks. I'm going to round just slightly just for the sake of ease of math here. All right. But the shares are basically worth $253, yes, and a few pennies. But we just don't think for a little while at least that the shares are likely to increase in price. So here's the second half of the covered call strategy. And that is we're going to go to the trade tab and we're going to sell an option. Now I'm going to sell an option with a very specific expiration, right? Ricebird, it is the hunt and peck. Yeah, my fingers are just, yeah, it's terrible. I can actually crank out about 40 words a minute, but I was in that generation where computers really hadn't caught on just yet when I was going through junior high and high school. Really, the only people that were typing were those that thought they were going to have sort of a clerical profession, and I didn't see myself going that route. Didn't at all anticipate what computers were going to become, so I didn't learn how to type and never did. Wacky says you type with two fingers. Yep, normal for an old man. Yep. Anyway, so here's what we're going to do. We're going to get into a contract. If you're not familiar with options, they're contracts. And they involve the potential exchange of shares. And specifically what we're going to do is eyeball, let's look at this date out here. May 15th is going to be our time frame for this example trade, where we think maybe the stock is going to pull back before it starts to rise again. We're going to get into a contract where we're going to agree to maybe sell our shares to someone else. Yep. Someone's going to be paying us for the right to purchase our shares. Now, that payment represents the income potential for this trade. And this is known as a covered call because for a period of time, and in this case, it's going to be through the 15th of May, someone's going to have the right to demand our shares from us. And in the old days, this would have been done over the phone. We'd give a call, right? But they'll have the right to call, back in the old days, to buy our shares from us for a prescribed price. So I want to keep a couple of levels in mind here. Notice 255 is sort of the price ceiling. Let's say that we're trying to avoid actually having those shares purchased from us. What we're really just doing here is trying to pursue the income potential of the strategy. So I'm going to go up to maybe $260 or even $265. What if we go to the trade tab? I'm going to look down through what's called the option chain. These are contracts that we might get into extending from one day all the way out to maybe multiple years. And I'm going to look at the 15th of May. 15th of May, 2026. These contracts are for the next 24 days, and they represent the potential exchange of 100 shares of stock. Hey, that's what we own. We own 100 shares. So I'm going to go to the 15th of May, and let's go down this center column that says strike. We're going to strike a deal with someone else where they have the right to potentially buy our shares, but here's the price we're going to require of them. If they want to buy our shares, we're going to require that they pay $265 for those shares. Now, someone can pay us right now a per share price. Looks like it's around somewhere between $6.45 per share and $6.70 per share. Let's say that we sell this call, selling the 15th of May, 265 call, and let's just call it $6.50. All right? That's going to be the call option portion of this trade. But again, explicitly what we're getting into is a contract where someone has the right for the next 24 days or through the 15th of May to buy 100 shares of Amazon from us, which we already own, but they have the right to buy those shares for $265 bucks. In order to secure that contractual obligation from us, in order to get us to sign on the dotted line, they're paying us, theoretically, $6.50 per share. For 100 shares, that's $650 of income that's being provided on day one, but with the huge asterisk, the obligation that we might have to sell our shares. All right, that's the deal. This is known as a covered call because at any time between now and the 15th of May, the other party in this transaction may decide to call those 100 shares, exercise their right to buy the 100 shares of stock from us. And if they do, they pay us $265 per share for those shares, in addition to the $6.50 that was already paid. Now, so we get 650 bucks out of this deal, but with the looming possibility that we might have to sell our shares. So under what conditions might the other trader decide to actually exercise that right to buy the shares? Well, if the stock happens to go up. Let me squeeze down the margin of my chart here for just a moment. So if I draw in a line up here, let's go up above today's candle, up to 265. Actually, let's use the horizontal line tool. There we go. Let's go up to 265. All right, about there. That's close enough. I'm going to draw a line out here to the 15th of May. And this is just a reminder. As a matter of fact, I'm going to right click and edit the properties. Let's make it exactly 265. There we go. This just represents that contractual obligation. So if the stock is hanging out down here below 255, as we suspect it might, and someone has the right to buy shares from us for 265, are they likely to do it? No. Nope. What they're hoping for is for the stock to rally sharply so they can get a discount on the stock price, a future discount. If the stock rockets up to 270, 275, 280, they know they can purchase the shares from us for 265. That's where the real benefit of this kicks in for the other party. But for us, if the stock stays down here below 255, or even if it goes up toward 265 but stays below, it remains unlikely, still possible, but unlikely that they buy our shares from us. And after 24 days, on the 15th of May, if the other party in this transaction has decided they're not going to buy the shares, well, we're left with the shares and we're left with the $650 of income that was provided. So this is an income-oriented strategy that does require share ownership, and it includes a potential obligation to sell those shares. All right, Clay says, when you have a moment, could you discuss the strike price selection? Yep, I certainly can, Clay. So for some income-oriented options traders, when they're doing covered calls, not everybody does it this way, by the way, Clay. Not everybody does it this way. But what they might do is look at where they think there's a price ceiling, and then they'll sell a call above that. What that does is, hopefully what we're trying to do is reduce the likelihood of assignment, the likelihood that the shares get purchased from us. Because if this does turn out to be the ultimate ceiling for the next few weeks, if the stock can't get above 255, if it can't get above 265 more explicitly, it remains unlikely that the other party decides to buy the shares from us. So we get to keep the shares and we get to keep whatever premium, the $650 that was collected in this case. That becomes the potential income for the time frame of the contract. Yarek says, what would be a losing scenario with this setup? That's an excellent question. Because let's talk through what sounds like a nightmare scenario. Ooh, this sounds scary. What if we were wrong? What if we thought the stock was going to stay below 255 and it goes rocketing on up? Let me switch my drawing tool here for a moment. I don't want to draw another horizontal line. Let's draw a diagonal line to start to envision this. Let's say that our stock just pops right through the ceiling. It goes above 265, it goes to 270 or 280 or whatever. It just goes up here. Well, on May 15th, the trader or investor that paid us the 650 bucks, if they haven't made this decision already, they have a decision facing them. We have a $270, $275, $280 stock that they can purchase for $265. Are they going to do it? Yes, almost certainly. They're going to buy those shares from us, and then we're left thinking, oh no, I sold the shares for less than they were currently worth. I sold them for 265 bucks. That's ouch. It's an owie. Okay, we can admit that. But is it a devastating outcome? We sold our shares for 265. They were purchased previously for around 210. That's actually it's a forced profit. That's what we did. We were required to sell the shares at a profit. Okay. So we made money on the stock, not as much as we might have theoretically made, because we're selling it for a little bit lower price. Plus, we're keeping the $6.50 that was originally paid. So the net there is sell the stock for 265 plus 650. That's like a 271.50 exit. All right, so that doesn't sound terrible. You know what can be terrible is if this happens. What if the stock, it stays below 255 and it collapses? I'm just going to exaggerate things to really show how this can, this is a strategy. It's not perfect. No strategy is perfect. The question was asked, how can we lose money on this? Well, if the stock starts to go in full collapse, we still own those shares. So let's exaggerate it. Let's say that in the next 24 days, something terrible happens with Amazon and it drops all the way to $180 per share. Well, it was worth 253, so we've given away all the profits we had, and now we're in loss territory on the shares. And you might think, well, that's okay because the other trader is going to come in and bail us out and buy the shares for 265, aren't they? No, they're not going to do that. Maybe somebody gets some crazy wild hair. They have the right to buy the shares for 265. Maybe they decide to. That would be amazingly uncommon in this sort of a scenario. Instead, what they say is, Cameron, I don't want the shares. I know I have the right to buy the shares. I don't want to buy the shares. And they walk. And so they leave us with $6.50 as this sort of pitiful little compensation prize, or what do you call it, consolation prize for the huge hit we just took on our stock shares. So a stock price collapse is how this strategy can fail. Now, that's not unique to a covered call. It's the same sort of exposure that we have if we just own the shares without doing a covered call and the stock price collapses. As a matter of fact, the call helped out a little bit. It gave us that $6.50 to sort of put a little bit of a Band-Aid on this gaping wound of a trade. But that's it. It's something that we need to be aware of is that a downside market just drop in price, if the stock is falling faster than the income that we can collect can make up for, that's how we can lose money, right? So this is known again as a covered call, because if we get the shares, this is the way that I think about it. It's not exactly the way that everybody describes it. But if the other party says, hey, Cameron, I want those shares, I might say, that's okay. I got you covered. I got the shares right here. It is a covered obligation. It's a covered position, covered call. So that's strategy number one. Now, I've gone through one example. I went through a specific expiration. I went through a specific strike price where we struck a deal at 265. There are definitely other choices that we might have made. So if you're interested in covered calls, here's a suggestion I have for you. I actually have a regular webcast series every Monday. It's called Covered Calls and Short Puts, and it's all about income strategies where we go into these in much greater detail. In this Getting Started with Options series, I decided to just give it 15 or 20 minutes to introduce it. So if you want to go check out that series, it's found on our Trader Talks channel. So once again, if you haven't subscribed to the channel, just pop down, click on the subscribe button. But you can find my webcast series, join the live streams here, or you can go to the playlist. So if I click on playlists and I go down, it's going to take a little bit of scrolling here. What we're looking for is covered calls and short puts. It's down right there in the center toward the bottom. You can just click on view full playlist And for example, you can see the discussion that we had just yesterday. Why covered calls often underperform, but also when they don't underperform just stock ownership. All right, so that was a good discussion, but let's talk about strategy number 2. Let's go back to, we've gone through income strategy number 1, which is a covered call. But what you may notice is this requires that we own 100 shares of stock. And some stocks can be way more expensive than others. This one, for example, we bought for about 210 bucks. For 100 shares, that's a $21,000 obligation just to get the ball rolling on the strategy. Now, for some traders, they're attracted to the concept of this strategy, but for whatever reason, maybe it's that the share ownership is too expensive. Maybe they just don't want to dedicate that much to the income strategy. There is a related strategy known as a bear call spread, also known as a call vertical spread. But let's discuss that. Let me grab this. I'm just going to copy and paste this because you know I don't have the typing skills, so I'm going to save myself time anywhere I can. And let's just go for income strategy number 2, which is a bear call spread. And one other thing that I might refer to this as is a credit spread, credit income. Yep. And I'm just going to use Amazon as an example. See, Mike says, Mike, oh, you're talking with someone else? Okay. Jay Richardson says, it's great that we get a beginner class to get an overview of the strategies and have classes dedicated to specific strategies. Exactly right. Yeah, and I'm only promoting mine right now because I happen to teach the one that reviews covered calls, but there are other coaches teaching other strategies in greater detail. Just check out our YouTube channel and find those strategies. As an example, yeah, we're going to vertical spreads. So we actually have webcast series that are dedicated specifically to vertical spreads. But let's talk about a bear call spread. It really starts with this. It starts with selling an option. The problem is, if we're out there selling options, we're getting ourselves into contractual obligations to deliver shares. And unless we own those shares, we might be painting ourselves into a corner. Mike, you don't need to be quiet. Don't need to be. I like the little sidebar discussions. Don't ever need to apologize for those. Anyway, but maybe a trader or an income investor who's just learning about covered calls, they might look at Amazon and say, yeah, but Cameron, if I were to do this strategy right now, it'd be a $25,000 trade that might allow me to get access to 650 bucks. Is there some way that we might dial down that initial cost of entry? And the answer is yes. Instead of buying the stock and then selling calls for income, we can actually buy a call option, which instead of buying the stock, instead of owning the stock, it gives us the right to buy the stock. And actually that results in a covered position, just like actual stock ownership. So here's what we're going to do instead. Instead of buying the stock, we're going to buy a call option to cover that obligation. So let's do this. Let's start off with this assumption. We're going to sell the 265 call, collect the 650 bucks, all good, except right now we call this a naked call position. They're not this. It's not like they're inherently illegal. They're not allowed in some kinds of accounts. But if we do get into this contract, we do have the obligation to provide shares on demand. But instead of just going and buying those shares outright, what we'll do is get another contract that gives us fixed access to those shares if we need them. So here's what we're going to do. Let's go to our trade tab. And at the same time we sell the 15th of May 265 call, we're going to buy another call that costs a little bit less. Let's go 15th of May because we need coverage for the full time frame of this short option, the one that we're selling. 15th of May, the next 24 days. And I'm going to look for less expensive contracts. How about we go to 270? let me just do some quick eyeballing. Yeah, I think that's actually going to be a fair example. It looks like our 265, what's it trading for now? It's no longer 650. We probably can't get 650 for it anymore. It might be more like 6.25. Let's change this just to reflect current prices. All right. But at the same time we sell that one, we're going to buy the 15th of May 270 call. And that looks like that's trading between 475 and 490. Let's say we have to pay $4.80 for that contract. In other words, it costs us 480 bucks. Here's what this one is doing for us. So if we get into the 15th of May 265 call, if we sell that, we know that we may have to provide shares. Someone may decide to buy those shares from us for 265. The problem is we don't own those shares. If we buy this call option, now we have the right, if we need to, not that we want to, but if we need to, on some future date, we could buy the shares for 270 bucks. Now, if you're doing the math on that, yes, I'm saying we're going to have an obligation to maybe have to sell the shares for less than we purchased those for. But that $5 less becomes the maximum that we can lose on this trade. What this $5 risk allows us to do, though, is to pursue income. Let's do some quick math here. So if we collect $625 at current prices, it looks like we might be able to get a little bit more than that. Anyway, we'll call it $625. CB says, how are you determining the strike selections? Again, you're asking some very legitimate questions. I wish what I could do is cram in 45 minutes a deep exploration of each of these big questions. I can't. So what you may want to do, if you want to, let's say, a closer look at strike selection, do a keyword search on our channel. Now, I haven't done this. I'm going to do a little bit of playing around here. But let me just type in strike selection credit. I don't know. Anyway, something that relates to the strategy that the element of the strategy that we have an interest in. Let me just hit enter. Oh, look at that. I didn't plan this. I didn't remember that I did exactly this webcast, but look at this. Strike selection is vital when trading credit spreads. Guess what we're doing right now? We're trading a credit spread. Yeah, so if you want a closer examination of that question, and it relates to Yarek's question, is it okay to have these deep in the money? Why not at the money? Again, that's strike selection. And when I dedicate 45 minutes to that topic, that allows us to look at different in the money, at the money, out of the money scenarios. Great. But in this case, I can at least tell you why we chose these strikes, because what we saw in our chart. The assumption for our covered call trader is the same as our bear call spread trader, and that is we think the stock is likely to stay below a specific price. And then what we're doing is giving ourselves a little bit of wiggle room in case we're a little bit off. If the stock goes above 255 with both the covered call and this call spread that we're structuring, there's some tolerance for that. Eva says, what a coincidence. Yeah, it just worked out that way. But believe me, I didn't ask somebody to ask the right question so I could tee up another one of my webcasts. But in any case, let's get back to the structuring of this trade. And we are putting that above our price ceiling. There's logic to that because this is a trade that works out best as long as we stay below the strike prices we choose. All right? So in this case, let's just do a quick recap of the two contracts we're getting into. The first one, someone has the right to buy shares from us for $265. I'm going to phrase it this way. We probably don't want them to. With this sort of a strategy, the trader generally just wants to get to expiration and see these things expire worthless. Now, if the other trader decides to buy shares from us for $265, we know worst case scenario, we can buy those same shares for $270. Let's all say ouch together, because If we buy the shares at 270, we sell them for 265, that creates a loss. Let's do the math. The theoretical maximum loss of this trade that we're setting up is the $5 difference between what we pay to buy the shares and what we have to sell those shares for. That would be a $5 loss, except we're getting paid to set this deal up. If we collect 625 and then spend 480, how much is left in the portfolio? My math says that's $1.45, right? So we get that credit up front. So that leaves us with $3.55 or $355 that can be theoretically lost on this trade. This is not the fun part of the trade, but I think it's important to highlight. Maybe we lead off with the risk to highlight how important it is to understand this. Well, how much can be made on this trade? What is the theoretical maximum gain? Well, it's how much credit we've received. It's actually the $1.45. So let me explain that. How do we make $1.45? And let's put this in here as well. It's 145 bucks. This is the driving motivation for this position. There's $145 of income that can be made. Now notice that's not nearly as much as we could make from the covered call, but also we're not tying up anywhere near as much cash. Remember, the covered call was basically a $25,000 initial purchase. Whereas with this, we can lose 355 bucks. So guess how much is required for us to essentially front 355 bucks? Yep. So let's start off with how do we make 145 bucks? And then we'll wrap it up with how do we lose the 355, again, to highlight that risk. All right, well, what we're hoping for here, let me just get rid of some of these drawings. Actually, let's just go back to our initial drawing. Remove this drawing. Let me remove this drawing. And let's just say that what we thought was going to happen is what happens. We bump our heads against this price ceiling. We pull back down here through the 15th of May, which is the contract period. Well, if the stock has pulled back a little bit, let's say it's gone from 252 and it's come down to 250 bucks. Well, someone has the right to buy shares from us for $265 that aren't worth $265. What are they going to do come the 15th of May? They're probably going to say, Cameron, I don't want your shares. Keep them. And by the way, at that point, the deal's over and we keep the 625 bucks that they paid us up front. Awesome. That becomes, in this theoretical scenario, a realized gain of $625. However, to cover this position, to make sure that we had access to shares if we need them, we also spent 480 bucks. And if the stock is only worth 250, even if we could buy shares for 270, do we have much motivation to do that? Nope. The shares aren't worth that. So our $480, we just let that right expire. That one's run its course. We lose the 480s. Now do the net math with me here. If we spent 480 and lost it, we collected 625 and realized a profit on that. What's the net between the two? That's our $1.45, which becomes our realized gain if our stock stays below those strikes at expiration. All right, so we have 265 and 270. Really, the stock doesn't need to go down here to 250. Even if it were to go up, but it's still below 265, this trader says, Cameron, I don't want to overpay for your shares. So we keep the 625. We decide, the shares aren't worth us buying them for 270 if they're not worth 270. So we lose the 480, and this creates that theoretical gain. It's actually a high probability outcome because if it goes down, we make our money. If it goes sideways, we make our money. If it goes up, as long as it doesn't go too far, we still make that money. Now, this is why it's known, though, as a bearish spread. We'd actually prefer for the stock to go down. It just gives us more breathing room. What about if the stock goes up? Well, if the stock rockets up, let's say it goes up to 280, 275, 280, somewhere above 270. Someone has the right to buy shares from us for 265. Are they going to do it? Yep, they're going to buy those shares. We say, crud. Now we've got to go pay 270. Shares are up here at 275 or 280 bucks. We can buy them for 270. Trying to minimize our losses here now. Buy the shares at 270, sell them for 265. Ouch. We just took a $5 hit. The $1.45 that we collected up front is only minor consolation for that. We lose our $3.55. So for this strategy, the way that we've structured this, we're basically tying up $355 in pursuit of $145. Now contrast that with tying up $25,000 in pursuit of 650 bucks. You can see how some traders can be drawn to that lower capital requirement. But we also just have to be aware it doesn't take an enormous move. Going from from 252 up to above 270, that can expose us to losing our full investment. So we have to be aware of the pros and the cons. Now, I realize that for most of you, for some of you, I should say at least, this is going to be your initial introduction to what are known as bear call spreads, also known as credit spreads, and you probably didn't catch it all. Don't put that pressure on yourself. Take the time to digest what we've discussed today. If you want a closer examination of these strategies, you can go to our YouTube channel and find a webcast that's dedicated specifically and exclusively to bear call spreads and watch those. All right? But what I want to do today, because I made the promise, let's go do one of our trades. Let's do the covered call. We're just going to sell that 265 call against the existing stock position. Wacky suggests you can watch this webcast twice. Yeah, it's a nice thing about these webcasts. The vast majority are recorded, put on the channel, and you can go watch them, slow them down, pause them, think it through, and then proceed. But I'm going to go to the trade tab. And as long as we do this in the same account where the shares are held, we don't need to call this a covered call or anything like that. We just go to the selected expiration, go to the selected strike price, and click on the bid price to create a sell order for contracts. Now, by default, it's going to be for 10 contracts. That would be for the potential sale of 1,000 shares of stock. Let's just do one contract. That's for 100 shares. But let's sell the 15th of May, $265 call. It looks like, yeah, we might still be able to get 625, probably not 650 anymore. Let's see if we can get 625 for this. And I'm going to click confirm and send. Selling the Amazon 15th of May 265 call, trying to collect $6.25 or $625. There is a commission that would chip away at that credit a little bit, 65-cent commission, leaving us with a minimum credit for this limit order that we're placing of $624.35. I'm going to send that order off. And we sold it. Look at that, $625. So there we go, guys. We've actually accomplished everything that I set out to do today. This was episode 2 in our 3-part series of the 3 reasons why options traders trade options. So we've talked about speculation in episode 1, income in episode 2. Let's move on to hedging for episode 3. I hope you'll join me for that next week. Time for me to let you go, but I'm going to give you a couple of quick reminders of the resources available to you from Schwab Education, starting with the YouTube channel. Make sure that you pop down below the video right now, click on the subscribe button. It doesn't cost anything to do that, but that subscribes you to our YouTube channel. It's called Trader Talks, Schwab Coaching Webcasts. But this is where you can find playlists of previous webcasts. You can join live streams. You can even do keyword searches for topics of specific interest. Another thing that Mike and I would suggest you do is to follow us on social media. You can find Mike and me on X. You can find Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS is my handle. I post on here frequently. And if you reply to one of my posts, I just try to reply right back to you. For example, recently I made an observation about what's going on with crude oil, and then asked my followers on on X, what do they think is going to happen with crude oil next? And if you reply here, I just go in and reply right back to you. It's a great way to have interaction with your favorite presenters in between the live streams. Now you can also find and follow us on LinkedIn. So my handle on LinkedIn, well, the place to find me is just go to linkedin.com/in. That's a typical prefix. And then /Cameron May CS. So here's my LinkedIn profile. Let me see if I click on the right one. Yep, there we are. I've only recently joined LinkedIn, so not as many followers here. But if you reply to my posts here, I just write a reply right back to you. So if you're wondering where to contact your coaches in between the live streams, it's on social media. All right, everybody, thanks for all the thumbs up. I can see 141 people watching the live stream right now. 57 have already clicked the thumbs up. That's really appreciated. It's like applause for your presenter, but also it gives my videos a nice boost in the YouTube algorithm so more people can find these discussions. But guys, I'll let you go. Enjoy the rest of our webcast for the rest of the day. I will see you in episode 3 next week. I'll be looking for you in other webcasts. In the meantime, I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.